Hello and welcome back to our channel. If you're preparing for a financial analyst interview, you're at the right place. Today we are going to discuss the topmost asked question that you need to know and how to answer them confidently. This isn't just about memorizing answers. I will help you understand the real world meaning behind these questions so that you can handle them with ease and ace your next interview. We have analyzed hundreds of interviews to create this list of 20 most important questions you need to prepare for. We will cover topics like balance sheet, cash flow, key financial ratios and even some tricky questions that might catch you off guard. So grab a pen and paper to take the notes as we go along. So that being said, let's look at the very first question. So starting up with the very first question, which is what is finance and what responsibility does a financial analyst have? Okay, so finance is all about managing money, how to earn it, spend it, save it and invest it wisely. As a financial analyst, your job will be to help people or companies make smart decisions with their money. You look at numbers, study trends and predict what might happen in the future. For example, if a company is thinking about launching a new product, okay, you would help figure out if it is a good idea by looking at the cost, potential profit and all the associated risks. Your goal will be to make sure that the money is spent in a ways that will bring the most value. So simply putting, finance is all about making smart money moves to ensure growth and stability. Okay, moving ahead with our next question, which is what is working capital? So you can think of working capital as the money a business has to keep things going every day. It's the difference between what a company owns that can be quickly turned into cash, like the cash in bank, the receivables or the inventory, and what it owes in short term, like the bills, the loans, etc. that need to be paid soon. So if a company has more thing it owns than it owes, if this own factor is more, it's a good spot to pay its bill and keep running smoothly. But if this owes factor is more, then it might have trouble paying what it owes. So working capital helps show if a business is healthy enough to keep things moving without financial stress. Okay, moving ahead with our next question, which is what is a goodwill? So goodwill is basically the extra amount paid during a company acquisition, representing intangible assets like reputation, loyal customer or unique technology. It's the difference between what the company's asset like cash or building are worth and what the buyer is willing to pay. This extra value often comes from things that are easy to measure, like a great reputation, loyal customer, good employee. To explain you in a better way, consider if a company A buys company B, okay, for 10 million, right? But company B's stuff is only worth 7 million. The extra 3 million is considered as its goodwill. Okay. So it's like paying for the intangible thing that makes a company special. It doesn't have an end date, but company needs to check every year if it is still worth the extra money they paid. Okay. Moving ahead with our next question, what is the difference between liquidity and solvency? Okay, so as the definition states, the liquidity is the ability to pay short-term debts quickly, and solvency on the other hand, it's ability to meet long-term financial obligation. It deals with immediate short-term financial health, whereas it deals with the long-term financial stability and survival. It's measured using current asset like cash, receivable and inventory. It's the total asset, the whole liability and the long-term debt. Its time frame is very short. It can vary from days to month and it has long-term time frame in years, you can say. So the key ratios include current ratio, quick ratio, whereas in solvency it is debt to equity ratio, interest coverage ratio. What's the importance? It ensures that the company can pay day-to-day bills, whereas the solvency ensures that the company can operate sustainably and avoid insolvency. For example, a company has enough cash to pay its month rent and salaries of the employees, whereas in solvency, a company can repay a 10-year loan over time without any financial trouble. Okay, so we can say that liquidity belongs to short-term commitments, whereas solvency refers to all the long-term commitments. Okay. Moving ahead with our next question, which is why is EBITDA important? Okay. So EBITDA is important because it helps us see how well a company is doing with just its core business activity without getting distracted by things like interest, tax, depreciation, and amortization. It's like looking at the company earning before all the extra stuff gets in a way. This makes it easier for investor and business owner to compare companies, especially across different industries. And why? Well, because things like tax rates or how much a company spends on equipment does not mess with the number. Okay. So it enables easy comparison of profitability across industry by avoiding the impact of tax rate and capital expenses. So it's a quick and useful way to check out a company's financial health without all the other extra complexities. Okay, so moving ahead with our next question, which is what is a capital structure? So capital structure is basically how a company gets the money it's need to run and grow. It's like choosing between borrowing money or debt or getting people to invest, which is also known as equity. Okay. Debt is like taking loans, while equity is like selling shares of the company to the investor. The way a company balances these two, show up on its financial report. If it borrows too much, it might struggle to pay back during tough time. But if it relies only on investment, it might miss out on opportunities to grow faster. Okay, so in simple term, capital structure is all about finding the right matrix of borrowing and investing to keep the business running smoothly and growing smartly. Right? Okay. Moving ahead with our next question, which is how a company show positive net income but go bankrupt. Okay. So a company can show positive net income and still go bankrupt because net income and cash flow are two different things. Okay. This net income, it reflects the profitability on paper by deducing the expenses, taxes, and depreciation from revenue. But this doesn't always mean the company has enough actual cash to meet its financial obligation. Okay. For instance, a company might report positive net income due to accounting adjustment like credit sale or non-cash item like depreciation. However, if the company doesn't collect enough cash from customer or spends more cash than it earns, it can run out of money. Okay. So to make you all understand this in a simpler manner, imagine this. You show a profit on paper, but you haven't actually received payment from client. Okay. So you're showing that you have so and so profit on paper, but you haven't received the money from the clients. Okay. Meanwhile, you still need to pay your bills, debts, or salaries. And if you don't have enough cash reserve or inflow, you could go bankrupt despite having profitable in your record. So you are showing that you have this and this profit, but you haven't received the money from client. So this mismatch between net income and real cash flow, okay, is why companies must carefully manage both their profitability and liquidity to stay financially healthy. And just positive numbers on paper won't help if there is no cash to keep business running. Moving ahead with our next question, which is what does WACC mean and how do you calculate it? Okay, so WACC or weighted average cost of capital is basically a company's overall cost of raising money. Think of it like this. When a company needs fund, okay, it usually gets them from a mix of sources, from shares or loans or sometimes equity. Okay, And WACC help figure out the average price the company pays for using that money. Okay, and how do you calculate it? So first figure out how much of a company's funding comes from equity and how much from debt. Okay, from shares and from debts or equity. Okay. Next, calculate the cost of each. The cost of equity using CAPM formula and cost of debt. Okay. And finally, by using this formula, you can calculate the WACC, which shows whether a project or investment will generate returns that exceed this blended cost, making it a key decision making tool. Okay. So this formula, equity by debt into cost of equity plus debt by capital into cost of debt into 1 minus corporate tax rate. So moving ahead with our next question, which is, what is financial risk management? Okay, so financial risk management is like a company's plan to handle money problems. It covers all the money problems, starting from spotting the risk, understanding them, assessing them, and reviewing the control. These risks could be anything like system breaking down, which comes under operational risk, losing money because of changing currency rates, foreign exchange risk, or customer not paying their debt, which is also known as credit risk, or even losing the trust with the public, which comes under reputational risk. So financial risk management is all about identifying potential financial risk a company might face and deciding whether to accept or reduce them. Simply put, it's like being prepared for the unexpected when it comes to money. You can think of it as like a safety plan a company makes to manage all the finance related issues. Okay, moving ahead with our next question. Explain the dividend growth model. All right. So the dividend growth model, or DGM, is basically a way to figure out how much a stock is really worth by looking at the dividend it pays. You know, dividend are those little payment company give to shareholders. All the little payment a company gives to its shareholder, like a reward for investing in them. The idea here is simple. So if a company grows by its dividend steadily, it's probably doing well and could be a good long-term investment. Now, how does it work? Okay. So the model estimates the stock future and then adjusts them to their present value using a discount rate. But it means figuring out what those future payments are worth in today's money. And if you calculate it higher than the stock's current price, it might be worth buying that. So it adjusts the future dividend projection to present value using a discount rate to assess stock worth. Okay. Moving ahead with our next question, which is, how do the balance sheet and the income statement differ from each other? Okay. So here you can look here in this particular table. The purpose of a balance sheet is to reveal the company's asset, liability, and the equity held by shareholder. Whereas the income sheet, it's only showcase a company's revenue, expense, and the net income. Coming to time period, it provides a snapshot of a company's financial position at a specific point in time, whereas it covers a company's financial performance over a specific period, usually month, quarterly, or annual. So the formula is the asset equals to all the liabilities plus equity or shares, and here revenue minus expenses is the net income. It helps assess a company's liquidity, solvency, and a financial stability. It helps assess a company's profitability, efficiency, and growth potential. Okay. So in simple term, you can say that a balance sheet answers to the question what a company have. So what do we have? Whereas the income statement, it refers to how did we do all these things. And together they give a full picture of company's financial health. Okay. So both are super important, but focus on different angles of the business. Moving ahead with our next question, which is why is the cash flow statement important for assessing a company's liquidity and cash management? So the cash flow statement is very important when it comes to assessing a company's liquidity and cash management, because it gives a clear picture of how cash is flowing in and out of a business. It breaks down the company's cash inflow, like all the revenues from the sales, and outflows such as payment for operating expenses, loans, and the investment. So by looking at this statement, you can easily tell if a company has enough cash to cover its immediate obligation like paying employees, suppliers, or handling unexpected expenses. And this statement helps identify if the company is generating enough cash from its core operation to sustain itself, or if it is relying too much on external financing or loans. So it manages liquidity, it assesses financial health, it helps in planning and budgeting, it identifies the cash flow, and it helps communicating with stakeholders. Okay. So this is all for this question. Moving ahead with our next question, which is what is the best evaluation metric for analyzing a company's stock? Okay. See, when evaluating a company stock, it's very important to use the right metrics to understand whether it is a good investment. There isn't a single best metric. Okay, there's nothing called as single best here. But there are a few key ones that values investor often rely on. First is price to earning. It measures the price paid for each dollar of earning. Lower price to earning may indicate undervaluation, and this can vary across industry. Okay. Second is price to book ratio. It compares the market value of a company's stock to its net value, and if this ratio is low, it could mean the stock is undervalued, suggesting a potential buying opportunity. Okay. Then there is free cash flow. It shows that the cash after operation and investment. Rising FCF often signal that the company is doing well and may reward investor with dividend or share buybacks. And lastly, we have PEG ratio. It considers price relative to future earning growth. A ratio under 1 suggests potential undervaluation. So using all these ratios will give you a clear picture of whether a stock is worth investing in. Okay. Moving ahead with the next question, which is how would you value a company? Explain the DCF framework. Okay. So let's break it down into something very simple and easy to understand. Okay. So if someone asks you a very simple question, okay. So the question is, how would you value a company? You could say that valuing a company is like figuring out if the money it's going to make in the future is worth investing in today. And one of the simplest way to do this is by using something called as DCF or discounted cash flow, which estimates the future money a company will make and adjust it to today's value to see if it's worth investing in. So it's like asking a simple question, are the future profit bigger than what I spend now? Okay. So it includes the each year's cash flow, and it's super handy for deciding whether an investment is good idea, and if the total DCF value is higher than what you're paying for the company, then it's a go for it moment, and if not, maybe it's not worth the risk. So how does it work? It works by taking in 3 factors. First is future cash flow. So in this, we estimate how much money the company will make every year, like the revenue after expenses. Okay. Then we have discount rate. So we use a percentage called the discount rate to adjust for the fact that the money today is worth more than the money tomorrow, because you can invest in it. And company often use something called WACC, you remember we just saw in one of the questions, is the same for this, and it's like the target return rate. And the third we have bringing it back. Now you can apply the DCF formula which adjusts those future cash flows to their present value. Okay, so that is all for this question. So moving ahead with the next question, which is, can you explain Porter's 5 force framework? Alright, so imagine you're running a business and trying to figure out why is it so hard to make money in this industry. That's where Porter's 5 force framework comes in. It's like a tool that helps you understand the game, who your competitions are, how much power suppliers and customers have, and whether new player or substitute can shake things up. It's basically a cheat sheet to analyze your business environment. Okay, now let me explain these forces with real world example. First is rival of competitors or competitive rivalry. So think about brands like Apple or Samsung. These guys are always trying to outdo each other for like better cameras, faster processors, sleeker design. And this constant battle makes it tough for them to charge super high prices because customers always have the option. Then we have threat of new entrants or potential of new market entrants. Now imagine you want to start an airline. But here's the thing, that it's super expensive to buy planes and you need tons of approval to operate. So it's not like just anyone can jump in. On the other hand, opening a coffee shop, it's much easier. Then we have supplier strength. This one is very interesting. Let's say you're building cars and you need chips from suppliers like Intel. If there's only one couple of companies making those chips, they can charge you a premium and you don't have much choice. You have to either pay it up or stop making the cars. Then we have customer strength, very important. Imagine you're a Walmart buying a product in bulk from small suppliers. You can demand lower prices because if they don't agree, you will find someone else. And customer here holds the cart. Then finally we have threat of substitute. Finally, think of Uber. It's convenient, but if the subway or bike rental are cheaper and work for your commute, why not those? And that's the real threat for Uber. They have got to stay competitive. Okay, so moving ahead with the next question, which is, what is RAROC? So RAROC is a risk-adjusted return on capital, which evaluate investment profitability by factoring in its risk, adjusting the return for potential losses. It adjusts the typical return on investment by considering the potential losses from a risky investment. And the idea here is very simple. Higher risk project should offer higher return to make it worthwhile. Higher the risk, higher should be return. In short, you can say that it provides a clear picture of how well an investment is performing after accounting for the risk involved, allowing business to make smarter and more informed financial decisions. Okay, moving ahead with our next question, which is, what do you mean by fair value? So fair value is the price of an asset that both the buyer and the seller agree on a fair market transaction. For example, if there is a company A and it sells the share to company B at 30 crores, okay. Company B believes it can later sell the share for 50 crores, making a profit. Even though company B stand to make a significant gain, the sale price is still fair because both sides agree. A side and the B side both agreed at 30 crores and it is considered as a fair value. In short, you can say that it is a realistic price agreed upon both the parties in a transaction, reflecting the actual worth of an asset under normal market condition. Moving ahead with the next question, which is, what is capital asset pricing model or CAPM? So the capital asset pricing model is a financial tool used to determine the expected return on an investment based on the risk by considering the risk-free rate, assets beta, and market return. So it uses the three main factors. First is risk-free rate. Second is the assets risk, and third is market's overall return. For example, if a stock has a higher beta, meaning it's more volatile than the market, the expected return will be higher to compensate for the additional risk. Okay, so you can say in a nutshell that CAPM helps investor decide if the stock is worth investing in by comparing potential return to risk involved. Okay, moving ahead with the next question, which is, how is cash flow different from free cash flow? As the definition only suggests, the cash flow stands for the total cash moving in and out of the company, whereas free cash flow is the cash left after covering the operational cost and the investment in the asset. So it includes all the cash from operation, investment and financing. It is the cash remaining after the operation expenses and capital expenditure. So in short, while cash flow shows how much cash a company is handling, free cash flow tells how much cash is remaining after the essential spending, and free cash flow gives investor a clear picture about the company's ability to generate extra money for growth or returns to the shareholder. Okay. Moving ahead with our last question, which is, what happens to a company's cash flow where there is an increase in account receivable? Okay, so when there is an increase in account receivable, also known as AR, a company's cash flow can face challenges. An account receivable represents the money that customer owe to the business for goods or services provided on the credit. Okay. As the AR balance grows, it means the company is waiting longer to collect payment, which ties up cash that could be used for daily operation or investment. In a simple term, imagine a company selling $10,000, and if these customers don't pay immediately, the company has $10,000 in receivable but no cash. This can create a short-term cash crunch, and the business might struggle to pay its supplier, employees, or cover the expenses. So you can say that the efficient management of AR, like faster collection or invoice factoring, can help avoid these issues. So that's all for this video. If you have liked this video, don't forget to hit the like and subscribe button for Intellipaat's YouTube channel. Thank you and see you in the next video.